Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macro economy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.16, which is up just a hair from last week's 6.15. This week we had pretty big news hit the market, so we're going to get into all of that, a little bit of data too, so let's hop into the charts. Looking at the US 10-year, we can see we are in this range right here. A lot of consolidation really with the 10-year. The 10-year just really hasn't wanted to break too far above 4.2 and hasn't really wanted to go too far below 4.1. We're in this consolidation range, which, this tends to happen. Happened over here. And usually when these things happen, there's a little breakdown or a breakout. So we're going to keep our eye on that, but we will keep it. While we don't know which way that the 10-year yield is going to go, we can make educated guesses based on data and headlines. As you can see, just the bond market has kind of stalled a little bit, so not too much buying or selling activity either way. Now, when we look at the economic calendar, what did we have last week? Really the big thing was labor data. Non-farm employment change, so 50,000 jobs were added. It was expected to be 66, but the unemployment rate was 4.4% and expected to be 4.5, so it was down from 4.6. So a little bit of a mixed bag as far as labor goes. I think moving forward, there are other aspects of the labor situation that we can see to really get a gauge on how the Fed is going to move. Inflation is going to be a big thing, and we actually got some inflation information today, so we'll talk about that in a second. But looking at the preliminary University of Michigan consumer sentiment, consumers feeling a little bit better. And then inflation expectations, a 4.2%. So looking at this week, today is Tuesday, January 13th when I'm recording this, and we just got CPI information. If you don't know, CPI is the Consumer Price Index, and this is one of the This is one of the inflation indices that the Fed uses to track inflation, but the preferred method is the PCE. But this is still really important for us to look at. So this morning we had core CPI month over month at a 0.2%. So a little bit of cooling on the inflation front, at least on the core side, month to month. Core is just excluding food and gas as they are volatile goods. Year over year and month over month were at expectations and did not change. So 2.7% and a 0.3% respectively. We also had new home sales. We had some September data. So it looks like in September, new home sales was good. Now this data, this is probably from, October. This is better than expected, 737, forecast 716, but it was lower just slightly from the previous 738. So looks like there's still new home sales. This is contrasted with existing home sales. So people are still buying homes. That's good. I'll be interested to see. I wonder if we can see. Can we see we can. So let's see. This is where we are. January of 26. So a tick up from the summer months of 25. It looks like a little bit in September. September, a good bit of buying, but I don't know. It looks like really like new home sales have really escalated. We had this big spike, right? And this was the golden period. If you got an interest rate at this time, you probably have a 2%. And, depending on when you bought, you might have you might have gotten in at really low valuations too, and then saw your value skyrocket. So, but really ever since 2010, right? Look, we've been going up. So no fear on that front. People are still buying homes. It has stalled out a little bit, but it's not as bad as it was 2010s, right? we did not have a housing crisis, right? It's just that houses are expensive. So let's see. We have PPI, producers side of inflation. We're going to see what that is on Wednesday. Also, retail sales. We're going to get October data, which this isn't that big of a deal. I mean, this new data is going to be much more prevalent than October data. And then we have Fed speak. So we have a bunch of Fed speak. Really, this just gives you, it's not that important, but it does give you insight into what certain members of the Fed are thinking. Now, speaking of the Fed, one of the things that I want to talk about in this week's episode is just some of the factors impacting this 10-year. And one of them is a federal investigation into Jerome Powell for, I guess, dishonesty about the Federal Reserve renovations. Jerome Powell actually had a video that he did stating how this was just, essentially political theater. The Fed needs to operate from a data-driven perspective and not from a political pressure perspective. And one of the things that this did, and it wasn't crazy, but it did incite a little bit of fear, I think, into the bond market and just a little bit of fear into the overall stock market, although it quickly got over that fear, is that the Fed may not be independent anymore. If we have the Fed bowing down to any politician's wishes, that is not good for the dollar. So we really don't want that to happen. An independent Fed is a very, very important thing. So I think because it was just announced that there was going to be a federal investigation, until we get more information regarding that, it's a little bit of a nothing burger right now. And Jerome Powell kind of called the DOJ's bluff on that. So, well, I don't know if it's a bluff, but Jerome Powell did not hide. Certainly, he went out and was very vocal regarding that. However, on the bright side for the 10-year, I do know that Trump, he got someone, I don't know who it was, but he ordered that, I want to say it was like $200 million worth of mortgage bonds be bought. Also didn't impact the 10-year that much. I mean, we're still in this range, but that's definitely good for relieving some of the pressure on the 10-year yield, kind of pushing it to the downward direction. We also had inflation data that was good. So like I've been saying, inflation is really, in my opinion, going to be key to this 10-year yield, seeing which way it's going to go. So if we keep getting inflation that appears to be cooling, I think that we see lower rates. If we get inflation that appears to be rising, I definitely think that the 10-year yield could inch up higher. So we need to see what happens with PPI and PCE when that's available. But if we look at the probabilities for Fed rate cuts, which, people get really fixated on these rate cuts. And also, like I've been saying, the rate cuts are not mortgage interest rate cuts. So that is very important. They can cut rates and the mortgage rates jump up. I think, like I said, inflation is a bigger deal when it comes to rates. Looking at why do investors want to buy bonds if inflation is stupid high, But it looks like we are going to get, well, it's priced in right now, 2 rate cuts in 2026 and then 0 in 27. This could change, so take that with a grain of salt, but that is what's going on right now. So when we look next week, we have MLK Jr. Day, so happy MLK Jr. Day. We also have building permits, housing starts, pending home sales, so some housing data right in here that'll be good to see. Core PCE price index, that'll be really important to look at. GDP, and then we have manufacturing PMI and services PMI. All important things to look at. All right, like I said, the 30-year fix ticked up just a hair to 6.16. up from last week's 6.15. That's all we got for you this week. So if anyone has any questions, comments, or concerns, reach out to us at 877-TEAM-MBL. If anyone is looking for a home loan or to refinance, it's definitely a refinance boom right now. So if you're looking for lower interest rates, give us a call at 877-TEAM-MBL or visit us at www.mortgagesbylinda.com. All right, have a great week, everyone. Bye.